Happy Tuesday, everybody. Just wanted to give you a quick market update as to what's going on in the mortgage world. Before I get started, just want to first of all say happy belated Father's Day to all of those fathers out there. Look, being a father is a very important role. I know I take it seriously. I hope you do too. A lot of great impact that we have as fathers. So happy Father's Day. I hope you had a great day with friends and family and those who mattered most to you. So now to get to the market. So just a couple things to highlight. Three main things that I want to point out. So last week, we've seen some extreme volatility in mortgage interest rates. So leading up to Tuesday, really from the Friday before leading up to Tuesday, we've seen interest rates go up probably 3/8 to 0.5%. And the reason for that was because of the inflation report that came out the prior week. So inflation report came in higher than expected, which really kind of had the market and all of the lenders saying, hey, we need to reprice and we need to figure this out. We got to digest what's going on. So we've seen some volatility and seeing mortgage rates go up. Then on Wednesday, so point number 2, Wednesday, the Federal Reserve met at 2 p.m. They had announced that the federal funds rate was going to go up by 75 basis points or 0.75% as opposed to the 50 basis points or 0.5%. Now, why is that big news? Well, that's the largest single increase since 1994. And it just shows that the Federal Reserve is being aggressive to bring that inflation down. So just one side note on this, the federal funds rate is not actually a direct correlation to mortgage rates. The federal funds rate is the rate at which banks borrow money. So typically when that rate goes up, it's supposed to help bring that inflation down. So we're reducing the amount of spending that's going on to help bring the demand down, which brings that inflation down. So that's the hope, is by raising the federal funds rate, we see inflation cooling off and hopefully coming back down. So it could be favorable for interest rates, which brings me to point number 3. Point number 3 is that after the announcement of the federal funds rate being increased by 75 basis points, we actually seen mortgage rates come down. We didn't gain back everything we had lost prior, but we probably gained about 0.25% back, which means it responded favorably to the more aggressive move. Now, does that mean that the Feds are going to continue to be aggressive? We don't know. Does it mean we're going to go into a recession? We don't know. There's a lot of different factors that go into that. And we are looking at several different things that could lead us to believe that we are going towards a recession, although the Federal Reserve does not want that to happen. Time will tell. If we hit a recession, don't hit the panic button. Recessions typically bring mortgage rates back down, which brings more buyers back into the market, which, as you know, we have a supply issue. Even with, a little bit, less buyers, we're still looking really good. So don't let it, be a big cause of concern. We might see the market cool down a little bit. Maybe we don't see as much growth. But I think we're still poised to have a very strong, real estate and mortgage market. So if you have any questions, or if I can help you understand this a little bit more, or if you want some of the information that I provided, the sources of that information, please let me know. But the big note is stay positive. Keep boosting your clients up. Stay in touch with all of your centers of influence. And yeah, be in touch if I can help. God bless. Have a great week.